We've been more cautious this year, which hasn't been a great call because the market's
since the beginning of the year?
Yeah, really since the beginning of the year. And the market's been great. I think it's just proven that this year is a lot more about how technicals and liquidity have been a lot more important than seeing an acceleration of fundamentals. So,
but what fundamentals haven't kept pace?
Well, if we look at things like earnings growth, we've had a pickup in earnings growth, but we've seen the PE advance much faster than the pickup in earnings. So, we'd say that if you look at forward multiples, they've increased by more than 2.5 times. So the median PE now is close to 19, and that's in the last 30 years. There's only been 4 quarters where the median PE has been higher.
But Tom, with the PE today, don't you have to factor in the fact that bond yields are so low? Does that skew how you should look at valuations right now for stocks?
I think that's absolutely one of the things we've overlooked, that with low interest rates and sort of in the absence of being able to look at other opportunities, stocks may be one of the places. And I think that's sort of the liquidity argument for equities.
Rebecca, you haven't been a bullish, pounding the table stock market person. You're neutral now on equities. Were you neutral January 1st?
We went from overweight equities to neutral last May, and we've stayed neutral since then.
That's bad.
Well, I mean, look, we left some money on the table by not having more equity exposure, but for our client base, we're talking about wealthy families.
Okay,
they don't want to have to. They don't want to lose it.
I always hear that. I understand that.
We want to make them as much as we can.
People have different reasons on why they invest, but going neutral in May was the wrong call.
Last May?
Definitely.
Yeah, but you know what?
That's 20% since May.
If we wake up tomorrow and we're at war with North Korea, having a diversified portfolio.
If my the expression.
No, I'm not trying to be defensive. I'm just saying, to Tom's point, valuations
I think you were too defensive on your stock.
Well, yeah,
picking.
I was.
Okay.
But if valuations are higher, the economic cycle is getting more mature, the liquidity slowly is starting to come out. I think it's prudent to take small incremental steps to slowly reduce risk in my portfolio, because then if we wake up and there's a shock, be it North Korea, be it a cyber attack, be it something else that triggers a recession, then we're going to have to be less reactionary. We're going to protect our clients' capital. And I think figuring out that balance is what my clients look for. It's not for every trader.
There's never a period on 365 days a year where you don't need to worry about something happening with a 10% downside. We all know that, but then you have to make your decision. Am I more bullish, or am I more bearish, or am I more neutral? So you always want to protect capital, and that just goes without saying.
Our diversified portfolio year to date, so 70% equity risk, 30% bond risk, roughly speaking, has still outperformed the S&P.
Okay. All right.
So if I can beat the S&P with 70% of the risk, I'm not unhappy about that.
Joe, you've been bullish.
We have. And I think one of the things that's been overlooked in a lot of these discussions is the second derivative of growth, which is the change, right? And that is that over the last year and a half, since February of 2016, things have been getting better versus worse. And I think a lot of people invest according to the notions of good or bad. Is the economy good, or earnings good? Is this bad? But what they're missing is that things have been getting better. And when you think about stock valuation, or when you think about corporate earnings, no one really cares how much a company earns. The first question they always ask is it better or worse than it was a year ago? And we've seen since earnings troughed in January of 2016 or February 2016, quarter over quarter, year over year, earnings getting better and better. And I think that's been, I think, a major key to this, equities rally over the course of the last year and a half.
I think what's been confusing, though, is that the signals that we've been getting from various asset classes don't necessarily confirm that things are getting better. I mean, you take a look at the rally in the bond market until just recently, where we've seen yields rally. I mean, it has been a confusing message, hasn't it? So where do you stand, and what do you make of that recent rise?
Josh doesn't have to worry about equities and being strong or not.
That's right.
You can tell.
I can be wrong on the economy.
Yeah,
that's happened before.
Bonds and bond yields.
Right, but you need to tell us exactly where we are in terms of the economy.
I think for the U.S., the beat goes on. I mean, it's not a particularly thrilling beat or a fast beat, but it's more plodding and methodical. But it's getting the job done. And literally, I mean, the labor market has largely healed. I think we're back at least in the vicinity of full employment. and that's no mean feat given where we were coming from. But in terms of comparing growth to where it was in past cycles, look, we're not getting the kind of growth that we had before, and we're not likely to get that kind of growth. The economy's potential to grow, I think, is diminished, reflecting demographic factors and other things. So relative to that bar, structurally we're not back, but cyclically I think we've accomplished a lot. And I think, well, to your point that the recovery is mature by historical standards, fortunately, recoveries are not like people. They don't tend to die of old age. They tend to die of a cause. And the normal sort of historical causes still seem largely absent. So.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.